morning and welcome to Business Morning. It's the last edition of the program for the week. Thank you for joining us. I'm Chimeze Obi Iwago. I will begin on the global oil market space as OPEC and its allies, known as OPEC Plus, on Thursday agreed to historic production cuts that will take 10 million barrels per day offline as the coronavirus pandemic saps demand for crude. The agreement came as the oil-producing nations held an extraordinary meeting to discuss production policy amid falling oil prices. Now, the group will cut 10 million barrels per day in May and June, 8 million barrels per day from July through the end of the year, and 6 million barrels per day beginning in January 2021 and extending through April 2022. All right, let's look at the implication of this. I'm being joined by a portfolio manager with Commercial Partners Asset Management, Victor Aluyi. Good morning, Victor. Thank you for joining us.
Morning. Thank you for having me.
Now, 10 million barrels per day, did you see that coming? And is that enough to combat the unprecedented demand loss from the coronavirus?
Yeah, I think just about the day before yesterday, we heard numbers around 20 million barrels a day. And that is precedent upon the fact that, analysts are estimating that the demand destruction from the COVID-19 pandemic is somewhere around 35 million barrels a day. So the 10 million number, as far as some analysts are concerned, would not be enough to really dent, or claw back the sort of the demand that we had seen being destroyed in the markets. So again, it's also important to state that the 10 million barrels cut as it is right now remains tentative because a particular member still hasn't agreed yet to what cut that they will take. Mexico hasn't agreed to take the 400,000 barrels per day cut. So that remains a sticking point. If that continues contentiously, then we might have OPEC announce something around a 9.6 million barrel cut a day. But for perspective, there's a G20 meeting that is supposed to hold today where OPEC Plus actually expects that other nations like the United States, Canada, and Norway would also implement certain curbs of close to around maybe 5 million barrels a day, which should bring the total curb to probably around 15 million barrels a day. If you look at how oil prices have reacted, when the meeting was going on yesterday and there was information that there was almost an agreement, crude prices, moved up quite strongly, testing 34 levels. On the back of the information again that, Mexico was not exactly agreeing to the cuts that it should take, crude prices retraced back downwards to around $31 a barrel. So the expectations are actually for a slightly larger cuts that would make a difference really in the markets. It really remains to be seen how things will pan out today with the G20 meeting and whether Mexico will indeed agree to those 400,000 barrels a day that it is supposed to take. Once we get a bit more clarity on that, I think the markets will probably react and they will see how to go from there.
Now, a lot of market analysts and, of course, participants in the global oil market fear that this G20 meeting may probably result to some kind of diplomatic fudge. Do you see that happening?
Well, it is possible, really, because at the center of this oil price war is a lot of political undertone, a lot of diplomatic maneuvering. Suffice it to say that the reason we had that oil price war that lasted for about a month was just basically on the back of the fact that a major producer like Russia essentially felt like they were just basically going to prop up shale producers in the U.S. if they continue to curb output whilst losing market share. So clearly, President Trump has come out to say that the U.S. output would automatically adjust based on market forces. Russia is saying that the United States should not just limit its output cuts to any automatic adjustment by market forces, that it should make commitments to adjust. But if you look at the markets in the U.S., it is largely private sector controlled. So I don't know how easy it would be for the president to try and rein in production, particularly for private shale producers. That remains to be seen. But really, there are strong political undertones to how that G20 meeting will turn out. And the outcome of that meeting will really have a significant impact on crude prices going forward.
all of these, what would be the implications for Nigeria's oil production target, which has been brought low to 1.7 million barrels per day? Just wondering what perhaps Nigeria's share of the cut could be.
Well, so the plan is that other members, apart from Russia and Saudi Arabia, would essentially cut their baseline October 2018 production by 23%. Baseline October 2018 production by 23%. So if I were to do a rough estimate of that, that would probably take Nigeria to around 1.6 million barrels a day. So essentially cutting a little over 400,000 barrels a day from our production, really. So if the broader agreement is able to stabilize crude prices such that crude prices are within or hover around the high 30s or probably even test 40s and average that for the better part of this year, given the budget assumption revisions that we have seen, it would help us to stabilize somewhat, but again, a lot still depends on how much further out we have to go, how much more this storm is going to rage, the COVID-19 storm. Because like OPEC has said, these 10 million barrels a day cuts will just go on for May and June. By July, it reduces to 8 million. And then by January 2021, it reduces to 6 million. Now, that is contingent upon the fact that the COVID-19 situation is, handled, or we see significant improvement on that front. OPEC is going to also have a teleconference on the 10th of July to essentially reassess, the market and see if there are any further steps that need to be taken. So for Nigeria, we're going to be cutting somewhere slightly above 400,000 barrels a day. Again, if prices are supported and with the budget revision assumptions that we have seen, we should be fairly okay.
If we're to paint a scenario where they perhaps come to an agreement, of course, there is no doubt it might give some kind of boost to the global oil price. But then the question is, how sustainable will that be?
I mean, the truth of the matter is that right now, what you have is a double whammy for the oil market. On the one side, you are seeing significant demand destruction from the COVID-19 pandemic, which we estimate has taken out close to 30, if not about 35 million barrels of demand a day out of the market. On the other hand, you are seeing, significant supply buildup on the back of this trade war or this price war that has gone on for about a month now. So clearly, you're going to have a supply overhang going into the rest of the year. Regardless of the cuts that we're seeing now, you're going to have a supply overhang. So what OPEC is trying to do is basically try and control that supply side of things. Because on the demand side, it's COVID-19 that has control of that, really. If COVID-19 rages further on, then that demand side destruction would probably even get exacerbated. But again, if we have a handle on the COVID-19 situation, then you will begin to see some demand-side recovery. So it's a double whammy for the oil market right now. And what OPEC is trying to do is to control that supply side, which is sort of have some control over right now. And agreements are, proving not as easy as you think they would be. So it's a really tough situation, really.
And with Nigeria being an oil-dependent economy, how will this global development influence portfolio investors' decisions on Nigeria?
Well, it's really easy. Nigeria is essentially an oil story. If you look at sub-Saharan Africa, you have Nigeria and Angola that are essentially oil stories. So what you've seen on Nigerian assets, particularly our stocks, also our dollar bonds, we've seen some price appreciation through this week, basically on the back of the expectation of a positive outcome of the OPEC meeting yesterday. So we've seen the stock market actually, gain 3 sessions, for the very first time since mid-January. We've not seen the stock market gain 3 sessions, since January. So we saw that happen this week. We've also seen a significant upward movement in the price of our dollar bonds. And all that repricing of Nigerian assets is particularly on the back of the fact that, analysts expect or have expected or priced a positive outcome from the OPEC meeting. So the impact really is that you're seeing some sort of positive repricing of Nigerian assets across the board. Hopefully this agreement holds. We will see that probably, continue. But again, in terms of sustainability, the real curveball or the real elephant in the room is the COVID-19 situation, is the biological issue. As long as we are able to control that or we see traction or some positive development on that front, other things will improve. But if the situation rages on and continues and we have a handle on it for an extended period, then at that point, really all better off.
And what is your short to medium term outlook for the global oil price?
Well, short to medium term outlook really is that, just like we've seen this week, we're seeing some sort of upward retracement, basically on the back of this OPEC output curve meeting. Truth of the matter is that it would be short-lived. Like I said earlier, if the COVID-19 situation does not improve, then whatever it is that OPEC is doing just prove it's late. The major factor here is for us to see significant improvement on the COVID-19 front. The truth is that OPEC cut as much as they can, demand destruction just continue. So that would it would be a really tough situation even for OPEC to follow in terms of cutting those outputs. So it's a bit of what I basically see in the medium term. Basically, you're going to see some sort of knee-jerk reaction in terms of oil prices reacting to these output curbs. But as it settles and as that fizzles away, as the reality of the COVID-19 situation filters through, then oil prices will basically adjust to that. So if there is improvement on the COVID-19 situation, you're probably going to see oil prices continue on the ascendant. If that situation does not improve, then that would significantly dent whatever potentials these output curbs should bring to prices.
All right, we'll wait and see what happens. Thank you very much, Victor Aluyi, for your time. Victor Aluyi is a head portfolio management with Commercial Partners Asset Management.